Hannah Kessler.
This gal started her own bank at the age of 18, and then you became a self-made millionaire by the age of 24?
I did.
Hannah Kessler is a money mentor.
She's known as the single millionaire chick.
With advice on how to stop living paycheck to paycheck.
Money starts with your mindset.
How you think about your money is going to greatly impact how much money that you have.
I grew up in a town called Olathe, Kansas. I'd be walking out of the door, going to school, and my mama would holler at me, "Hannah, make good choices." And I'd have to holler back, "Because the choices I make today will affect my future."
My parents, they did a very good job about teaching me as a child how to handle my money. We have a lack of understanding when it comes to money.
If you want your kids to have money, you need to start talking to them about it while they're young.
I'm really second generation to this concept that's called the infinite banking concept.
And at 18 years old, my dad gave me the choice to start my own bank that then led me to becoming a millionaire by the time I was 24.
Now you've written a book to help tie it all together.
So the companion is really just teaching kids that, not specifically money, but really important life lessons.
Now being the owner of the Money Multiplier, I help serve over 17,000 clients in every state of the country.
Where can people get the book?
HannahKessler.com. Hannah spelled the same way forwards and backwards, Kessler with one S.
Also, I got my podcast show, the Money Multiplier Podcast.
And make good choices today, because the choices you make today will affect your future. Good morning, my friends. How are we feeling today? Happy Thursday. Devon, good to see you. Justin, what's poppin', my man? Good to see you on this morning. Okay, I know I'm a little tardy. Sorry, my friends. I had to do my yoga this morning. Okay, so you can't be mad at me. I have a fun and exciting topic today. As always, I'm here 9 a.m. Eastern time every Thursday morning with Money Mornings with Hannah. And if you can't catch the live stream, you can find the replays on YouTube or on your podcast platforms. Wherever you stream your podcasts at, go and search Money Mornings with Hannah, and then you'll find the podcast episodes there. And also, if you don't want to wait for Thursdays, just FYI, I also have the Money Multiplier podcast, and that goes out every Tuesday on YouTube and then also the podcast platform. So just search up the Money Multiplier podcast. All right. We should maybe even start here. Y'all have seen the headlines last week. Okay. Last week, I got a notification on my phone, and it was through Fox News, and Fox came out with the article that Kyle Busch passed away. All right. And if you remember, a few weeks ago, we got into the whole discussion of the lawsuit with Kyle Busch, his family, and Pacific Life. So the article popped up and it says two-time NASCAR Cup Series champion Kyle Busch tragically dies at 41 after hospitalization. And my first thought is, oh my goodness. Well, first of all, how's Samantha doing? His wife, how are the kids doing? And my second thought was, oh crap, did those policies get transferred before this whole lawsuit came about? And and we can actually confirm this. So if y'all don't know Bobby Samuelson, he posts out great blogs in life insurance, annuities. He's really an expert over there, and also even updates on what's going on within the economy. But I follow him on LinkedIn, and he made this post about 2 hours after the article came out on the news platforms. And he goes, Kyle Busch's death is an absolute shock and tragedy. My prayers are with Samantha and the kids. Fortunately, Kyle had life insurance coverage he and his family needed. The Pacific Life policies referenced in the lawsuit lapsed well before the litigation began. His remaining policies had already been exchanged for more suitable coverage, specifically to provide adequate death benefit. He made the comment that Charlotte is a big city, but a small town. So just take my word for it. So I don't know where Kyle Busch actually lives. So I'm assuming that he was living in Charlotte, and that's where Bobby is living as well. So he kind of got that insider scoop. But then it kind of made me start to think about, when I travel around and I teach on the infinite banking concept and talking about the living benefits of whole life policies, a big topic comes up from some people where they're like, hey, well, I don't need life insurance because I'm self-insured. I'm self-insured. I don't need the life insurance coverage. And it's okay to have that mentality, right? I mean, there's no right or wrong way to live your life. What I just do is I just follow what the elite and the wealthy are doing, and they're putting money away into permanent coverage, whole life policies. But even to that aspect of being self-insured, sure, right? But we got to understand that the reason for life insurance, what even is the purpose for life insurance? Well, the purpose for life insurance is that when the time happens, because we don't know when, that we're going to get called to go home. So when that time happens, there is going to be a loss of income to the family, right? And that loss of income, that's our number one asset at the end of the day. You are your number one asset, and your ability to create, not even monetary ways. I mean, obviously that's what we think about when we're thinking about life insurance and just our family, supporting the family from the monetary standpoint, but really just putting like a big broad spectrum on it. It's your ability to create and give back to your family, the community, the world, essentially. That is your number one asset. And that's where, kind of to go into the whole philosophical side of it, philosophical side of it is, giving back. Why is the purpose that I'm here on this planet? What is my duty? What is my mission, right? And so life insurance is there to protect your family or your business, your charitable organization, maybe that you run, in the event of a premature passing. So that death benefit now, even in this scenario of Kyle Busch and his family, even though he was worth millions and millions of dollars, it's there to protect the vault. It's there to sustain the lifestyle that your family currently has, even if you were to pass prematurely. Because it also got me into the perspective of 41. Holy crap, in 15 years, I'm going to be 41. 15 years goes by pretty darn quick. I mean, let's just talk about it. We're about to get here into June 2026. We're halfway through the year already. So time really does go by, and it goes by very, very quickly. So the whole topic of self-insured. All right, sure. If you want to be self-insured, whatever. But my feedback, or how I personally look at it, is that it's there to protect my monies, my dollars, my assets. And more specifically, if you want to even get deeper into the rabbit hole, it's there to protect against probate court, or the attorneys, the government, taxes that I got to pay on my estate when I pass away. How can I transfer this wealth tax-free to my heirs and my next generation? You see what I'm saying? But I just want to kind of bring that up because that was the big topic of last week. And I got some content actually that's going to be going out on my Instagram channels. All right. So give me a follow. You can search up my channels just by searching my name, Hannah Kessler. Hannah spelled the same way, forwards and backwards, Kessler with one S. But I really want to get into what your life insurance agent may not be telling you. Okay. Because I know life insurance is not traditionally a mainstream topic. You may see like the commercials that are played on the television, or even the radio commercials, like I'm driving in the car and sometimes I hear the commercials of, hey, just in 2 hours, you can get qualified for life insurance, $50 a month for $1 million policy. And obviously, just knowing this world, they're obviously talking about term. So I really want to get into the conversation of what are the different products that are out there, because there's no one size fits all. We all have different needs and goals within our life, and no product, I would say, is better over the other. Now, today specifically, we're going to be talking about term and whole life. Okay, I don't want to get so deep into the conversations of IULs, universal life products. Okay, you can go back to past episodes where you get deeper into that. But I really want y'all to understand the differences of the term insurance and then also permanent insurance. Okay, before I see some comments coming in, hey, yoga is good health as well. Absolutely, my friend. Alfredo, good to see you. You're probably working, so hopefully everything's going good today. Also, Annette. Dave says, good morning. Your hair looks great. Okay, let's talk about it. I am growing out my bangs. I am ready for a new hairstyle. So we're growing them out right now. We're in a little transition phase. All right, so keep you posted. All right, good. And I also see Margaret, Josh, and then Lisa. Good morning, my friends. All right, I don't know if y'all know this statistic, but 50% of Americans do not have life insurance. Half of our country does not have life insurance. And it's either because they maybe can't afford it or they just don't fully understand it. But that's my mission that I'm on, is that I want more people to have life insurance on their bodies. I want them to protect themselves and their family from those unforeseen times. Okay, so here is where we kind of discussed already what is life insurance, right? So what is life insurance? Well, life insurance is really there because it allows me to have that protection in the event of a premature death. Okay, so specifically, there's going to be a loss of income for the family. And if I can provide the dollars for my family to sustain their same lifestyle, to even take away time from work, because there's going to be a grieving process. You know, maybe I want to take a year break and just go do something else with my life as I grieve through this new reality that I'm now in and now that I'm facing. So that's really the purpose of life insurance. And I've said it before, but I'm going to say it again. Life insurance is the only insurance that's actually guaranteed to happen. Is it not? I mean, we're all guaranteed to pass away and graduate at one day in the future. And we just spend a lot of money on other insurances. And I understand, like, legally we have to have some other insurances, but we spend buku bucks on these other insurances that are all if insurance, if it may happen. But life insurance is not an if, it's a when. When is this time going to happen? So the differences, okay? The differences between term life and permanent whole life specifically here. Well, term, I always say it's renting the coverage, right? It's there for that set amount of time. So whether it's a 10-year term, 15-year term, 20-year, or maybe a 30-year term policy, that policy is there for that set amount of time or that term. And then after that term expires, well, then there's no more life insurance there, right? I'm at the end of my contract and now there's no more life insurance. I got no more death benefit protection. Where on the flip side, whole life, hence the name, is there for our entire life. It's permanent. It's whole life insurance. And so thus that death benefit is going to be there until we are age 121. 121 is how long the contracts are going for nowadays. And there's been some conversations like, you know, some people will ask me, well, Hannah, with, people living longer, are the insurance companies going to come out with new products? And are they going to be increasing the time frame of those permanent policies? And yeah, they are. You know, if you go back through history, that's how they've even continued to expand it. Now it's at age 121 because they understand that, folks are living longer. I should look that up. Do y'all know this? Put in the chat box if you know it. What's the longest anybody has ever lived? I should know that, but I don't know that. I'll do some Googling after this. But that's the differences. So term versus the whole life, the permanent. Now, here's the thing that we got to take into consideration. The difference between term and whole life. We like term because it is cheaper, okay? Just like in my analogy I always use, term is like we're renting the house versus whole life is like we're buying the house, okay? When you buy a house, most of the time it's more expensive. It's more cost to me. And just renting, it's a little bit cheaper for me. And that's why we like the term, because we can go out there and buy like a $50 a month policy and get like $1 million of death benefit. And most of the time people are like, ooh, yes, sign me up for that. $50 a month for $1 million in term. Absolutely. Okay. And we do like it. It serves its place, right? I remember I had a family like 2 years ago, it was a few years now, where the dad was a firefighter and mom was a stay-at-home mom. They're raising 6 kids, and there just wasn't a whole lot of cash flow that was coming into the family. So it just made more sense to protect the dad, because first of all, his job is risky, right? I mean, you're going into burning buildings and saving cats from trees. I'm kidding. That was a funny joke. but he's got a more riskier job because mama is the stay-at-home homemaker, if you will, raising the family, raising the kids. And because of the cash flow that was coming in, it just made more sense for him to have that term policy right now. And we got to also understand, because it is term, let's take the example of like a 20-year term policy. If I'm paying $50 a month for those 20 years to get myself the $1 million of death benefit, well, at the end of those 20 years, now there's no more life insurance. So now what I got to go and do is I got to go requalify, okay? 20 years into the future, requalify for that new policy. And because I'm older, there's going to be more cost to it. So maybe in the future, after those 20 years, it's not costing me $50 a month. Maybe now it's costing me $150 or $200 a month because I'm older. That cost of the insurance is more expensive now because it's based off my age, right? That's how life insurance is priced, right? Your age, your health, and where you're at life right then. And because we are waiting to those 20 years until the term policy does expire, number one, now it's going to be more expensive on the premiums, but then also you got to make sure that you can still qualify for your health side, because that's another thing. You never know if you're going to get diagnosed with a medical condition. Cancer may run in your family. Maybe you get dementia or something happens, right? And you just can't qualify for that policy in the future. So that is where I kind of enjoy convertible term policies more, okay? Convertible term is a term policy, all right? It's cheap. It's getting us that death benefit. It's renting the coverage for that set amount of term time. But the convertible aspect of it is you can convert that term into a permanent product like whole life, and you don't have to do the underwriting for it. You are essentially locking in your death benefit at the time that you're getting that term life insurance policy. So, my friends, if you are wanting the death benefit protection, instead of going the term route, and you maybe need to go the term route right now, I would suggest looking into convertible term so that then you are locking in your insurability, and then you can convert the term into whole life later. And so to my topic, what your life insurance agent may not be telling you is there is a convertible term policies that are out there. Now, do I know if every single life insurance company here in this country offer convertible term? No, they probably don't. But, you know, just with my 6 companies, yeah, all of them offer that convertible term product. So I would encourage y'all, I mean, hey, if you want to have that conversation, reach out to me. You can send me an email, hannah@themoneymultiplier.com. We can have that one-on-one conversation. But I would recommend really going out there and getting the convertible term for right now. Even my folks who are in their 20s, okay, my lovely people. Mr. Connor, if you're tuning in this morning, which normally you do. I'm thinking about you and your wife, how you got Jordan approved for her convertible term. You still got your permanent policies on Jordan, but you also max out her insurability with that convertible term policy. And what are you now? You're like 30s. You're late. No, she's 20. She's in her 20s. You're like early 30s. So you don't got to be older to start thinking about life insurance, right? Queuing up Brent Kessler. A failure to plan is a plan to fail. Okay. So start prepping for these times. Think long range. That is one of the principles that R. Nelson Nash teaches us within the infinite banking space is think long range. Don't just think for the right now, think into the future. What happens when I'm 60, 70, 80, 90 years old? And what's even going to happen when I'm no longer here? What's going to happen with my family? And how are they going to continue on with their way of living? Okay. Real quick, we got some feedback. Yulia, good morning, my friend. She says, based on a quick Google search in the US, it's 115 years old. And I also got another stat from Annette. Annette might be looking at the world. 126 years old is the record. Okay, now here's your next Google search, my friends. How did they get to live that long? That's what we want to know. What did they do to get to live that long? All right. Obviously, they're probably taking care of their health. That was my big PSA when I ended last week's episode. Your health is your wealth. Take care of yourself. All right. So now it kind of gets into the differences of the philosophies of life insurance. And a big one I want to talk about today is buy term and invest the difference versus the infinite banking concept. Now, buy term and invest the difference, it has its place. Okay. Like I said, term has its place. Term is a good product and it has its place. It serves its purpose. Again, I would encourage convertible term. And let's just take two different scenarios, okay? Let's say that I have, should we give them names? Let's give them names. Let's say I have Andy, okay? Person A, we're going to call them Andy. And person B, we're going to call Bernie. Yes, Stephen Nagy, I'm thinking about your dog right now. Okay, so we have option A, or scenario A, Andy, and we have scenario B, Bernie. Now, Andy is going to follow the philosophy of buy term and invest the difference. And Bernie is going to follow the utilizing cash values and whole life insurance to make investments, okay? If I were to do an apples to apples scenario, Andy, let's say that for $1 million of death benefit, it's going to cost them $100 a month or $1,200 for the year. Okay. And for Bernie, for permanent whole life coverage, and now I'm going to be clear that we're designing this policy for immediate high cash value. Okay. So designed on the forefront for this infinite banking concept. Let's say that Bernie, it's going to cost them $500 a month or $6,000 a year for that permanent death benefit of the $1 million. Okay, so we have an apples to apples scenario of the same amount of death benefit protection. Where Andy is going, what Andy is going to do is Andy is going to buy the term. Okay, so it's costing them $1,200 a year, and she's going to invest the rest. And what they mean by that is saying, okay, if I buy a permanent whole life policy and it's going to cost me $6,000 a year, well, the difference between the $6,000 and permanent minus the $1,200 from the term of what it's costing me, that $4,800, okay, the difference there, we are going to take that $4,800 a year and we're going to go and invest the money. And it doesn't matter where you invest the money at. Invest in the things that you like, know, and understand is what I always say. And it could be into the stock market. It could be into real estate. It could be into oil, gas. It could be into a business venture if they choose, okay? But they're going to invest the rest. And so every year, $4,800 is going to go towards investing the rest. That's scenario with Andy. Scenario with Bernie, is Bernie is going to take the cash value from their policy immediately within 30 days. And now they're going to be using other people's money to go and invest the difference. Okay. Because in a $6,000 a year contract, you could totally have $4,800 of cash value available depending on that policy design, right? And when you follow what the elite and the wealthy people are doing, is they are never investing their own money. They're always using OPM. Have you guys heard that term before? OPM, other people's money. And what Bernie is doing is they are collateralizing their policy, and they're taking out the cash value and they're investing it into stock market, real estate, et cetera, et cetera. And when Bernie is taking the cash value from their policy, they're taking out a policy loan, okay? I know a lot of y'all know that if you've been following the channel for a minute, but let's just kind of break it down for some of my newer listeners. We're not withdrawing the cash value from the whole life policy. We're taking out a cash value loan. What that means is we're putting the death benefit of our policy up for collateral. We're collateralizing against the death benefit, and we're taking a loan from the general funds of the insurance company. So we're using their $4,800, and that's what we're going and using to invest in the first year. Now, what's really the difference is, right? Well, the difference is here is that in Andy's example of utilizing the term policy, they're using, or she, let's say it's a she is using her own money, okay? She's using her $4,800 every year and investing directly. And thus it's not affecting the death benefit that's on the policy, right? Because term, as long as you're paying your $100 a month or that $1,200 a year in this example, she's always going to have that $1 million of death benefit. Where the difference on Bernie's side is if I'm collateralizing my death benefit, if I'm taking out $4,800 of cash value, I'm reducing my $1 million death benefit by $4,800. Does that make sense? Because if Bernie were to pass away in this first year, let's say, God forbid, what the insurance company will do is they'll take her $1 million of death benefit, subtract the $4,800, and then that remaining portion, the $996,200, that's what's going to get paid out to her beneficiaries. Okay, you following me? So that's really the differences if I compare the apples to apples. But here's the thing. Are people actually investing the rest? Who's holding you accountable to invest the rest? You know, it's up to you and what you're doing with your policy or your cash flow, I should say, to invest the rest. So my biggest PSA, if right now it makes more sense to do term, buy the term and invest the rest, actually invest the rest, my friends. Okay, that's my biggest PSA. And even with the whole life policy, same thing. Do what you're saying you are going to do with that money. Invest the rest, which kind of gets me into like a topic that I was thinking about last week when I was talking with the implementation team. The implementation team, all right, FYI, if you don't know who they are, if you're a member of the Money Multiplier and you hold policies with the Money Multiplier, you have your designated implementation agent who's there helping you, checking in on you every quarter. It could be Jerome, Larry, Wesley, there's even Ethan, okay? But the feedback that Wesley and I were actually talking about last week is he's like, these people sometimes just totally over leverage themselves. And I just kind of wanted to bring this up at the forefront right now of don't totally over leverage yourself. All right. It is important to have cash reserves stored somewhere. I know a lot of people within my real estate community, you guys are kind of feeling the pinch of what's going on within the market right now. And maybe you need to have some of that cash to float through your business to just sustain cost of living right now. So always just make sure that you do have cash reserves on hand for when you need the money. Okay. There's just been some scenarios where people are totally over leveraging themselves and they're not preparing for the unseen times. They didn't plan for the unseen times and they just totally over leverage themselves. And it's not the best for us. All right. Lack of better words. What I do is I keep 6 months. Okay. So here's what I do. I keep 6 months of reserves on hand. All right. I keep 3 months of my overhead expenses at my local bank, and I keep 3 months of my expenses in my policies. And that's monies I don't touch. That's my reserves. That's if shit hits the fan. I got money that's sitting there that I can float the same lifestyle for at least 6 months. And the idea is that if that does happen, or if I ever do get to that time, well, hey, I also got 6 months to readjust and, minimize my expenses, cut out some spending, maybe look at some other ways I can produce some more income, blah, 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 right? But at minimum, to sustain the same livelihood that I have now, I got 6 months of my expenses that are covered. You could even take it out a full year, do what feels right to you. This is just what feels right to me. There's no rhyme or reason, really. So my biggest PSA is that do what you say you're going to be doing. And I know I'm looking down, but it's because I have my notes here. I was thinking about this morning. All right. Buy term and invest the difference. Whole life uses other people money to buy the investments. Here's the biggest thing too. Whole life is not an investment. It is not an investment. Your retirement accounts are your investment. Your brokerage account is an investment. An investment, in my definition, is it involves risk to it. It involves some form of risk, meaning that it can go up in value or it can go down and lose value. And I know even a lot of us don't even look at our 401ks or IRAs like it's an investment, but it is, okay? Because it's going to go up and down based on what is the market doing? How is the money being invested? Even in like a self-directed IRA where maybe you are using some of those dollars to invest in real estate directly, self-direct, that's what we love about self-directed accounts. You can self-direct how those monies are being invested, but it's not an investment. Whole life insurance is not an investment because it cannot lose value. The best apples to apples comparison that you can use between whole life to another product is like a savings account. I mean, that's what it is. Even in a savings account, all right, not to go totally down this deep, long rabbit hole and like go all the way there, but even in a savings account, you could lose money. I mean, yeah, it is quote unquote backed up by the FDIC. But that FDIC is tied to the Federal Reserve System. And hey, did you know that what was it? In the past 5 years, no, it was 7 years. In the past 7 years, 50% of the money that's circulating the economy was printed within the last 7 years. Because our money's not tied to anything. Our money is just fiat currency. And so what does the Fed get to do? If they need to do it to keep the peace and the calm that's happening, well, they just open up their back doors, turn on that printing press, and then now there's more money circulating into our economy. And then, inflation is so high and cost of living and blah, 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 blah. All right, but we won't go all the way down that rabbit hole. That's why I have my other podcast show to talk more about that on. But a whole life policy is the best comparison you can make to it is to like a savings account. You earn an interest inside of it. Okay. And honestly, you earn a better interest inside of your whole life contracts than what you can find in a savings account nowadays. And even if you have a high yield savings account, sure. What are you getting? 4%? Okay. 4% on the money, but is that tax-free or taxable growth that's happening in your bank account and that savings account? It's taxable growth. Whole life policy, it's tax-free growth, tax-free money that's happening. So there are differences there, but the best comparison that you can make to like a whole life policy is to like a savings account that has a death benefit on it. Now, remember, it's not a savings account, it's a whole life contract. Okay, compliance, right? But that's the best comparison that you can make with it. So whole life is not an investment in my eyes, in my definition, because it can never lose value. It can never go down. You have a guaranteed contractual interest that policy is paying you for the life of that contract. It's written inside of there. So earns better than a savings, but whole life, I can get better returns inside the market or inside my real estate investments. And so that's a big comeback that people will come back to me is, well, Hannah, why would I put my money inside of whole life and just get this boring guaranteed interest when I could go take that money and get, let's say, 12% on a private lending deal on real estate, right? I get it, but it's not my either or. This is my and asset. Your money has to be stored somewhere, okay? That's the foundation to what Nelson Nash teaches us within becoming your own banker. Your money has to be stored somewhere. And when you're looking for places to warehouse or store your money, what are you looking for? I'm looking for control, okay? I want to tap into this cash bucket and use my money for what I want when I want. I don't want to have to ask permission to utilize my money, right? So I want the control. Again, I also want the liquidity, having access to the cash. Also, if I store my money somewhere, I want it to be protected, like in Sue Happy America. Hey, my whole life contracts, it's a protected asset. If I get sued, have a lien against me, no one can come after the dollars within inside of my policies, but they could come after some of those other accounts that I may have, like the Roths, the IRAs, 401ks, your bank accounts. So if I'm storing my money somewhere, I want it to be in a protected place where nobody can essentially get access to my money. That's a way that I'm looking at a place to warehouse it. And then also on top of that, my opinion, I want the government out of my hair. Yeah, I want to legally pay the taxes that I legally have to pay, but I don't want to totally pay out Uncle Sam all of this money. I want to keep the money that I'm making. That's the biggest thing. Because even like a lot of my W-2 income earners, like high income earners, y'all could be making $600,000 plus a year, but if you're spending out $550, who cares if you're making $600 just to keep $50,000 a year for yourself? Okay, it doesn't matter how much you make; it only matters how much you keep. So, again, whole life is not an investment, and it's not the either or. It's my and. I'm gonna utilize the cash value within the policy to then go buy that investment of the real estate, stock, options trading, etc. Which, by the way, too, a lot of my people have been having a lot of success within options trading. That's something that's on my list that I really need to dive deeper into. Like, shout out Larry Steinhaus. I'm thinking about you, my man, and your options. What do you call yourself? Options Sultron? Am I saying that right? Justin, if you're still listening, chime in. Hopefully I'm saying that correctly. But a lot of people are actually having a lot of success within their stock options portfolio. Like, there was a guy who is a client of mine. He posted out on Facebook. He's like, dude, within the last 6 months, I've made 50% returns on my stock options portfolio. And I'm like, that's a pretty cool gig. Maybe I got to research this a little bit deeper. Anywho, so that's something I kind of want to get deeper into as well. All right. And then we talked about the convertible term option. Okay. Justin says, not sure, but he is the man with the options. Good. We did talk about the convertible term option. Okay. So I would highly, highly encourage y'all, get that convertible term. Okay. If you don't have life insurance on your body and you can willing to do like $50 a month into a policy, reach out to me. We can run some quotes together. There also, my mind is kind of wandering down the track of how do I know how much death benefit I should have on my body? Okay. And there's a whole bunch of different variations of how you can look at this. Like, maybe I want to get enough death benefit so that if I were to pass, my mortgage is going to get paid off. All right. Or if I were to pass, I want to make sure that over the course of 5-10 years, there's going to be a cash bucket that gets paid out that equals the amount of income that I'm making right now. So number example, let's just put this in number perspective. Let's say I'm making $1 million a year, just for easy math. And I want to make sure that my spouse has 5 years of income coming in that's going to replace my $1 million of income. Well, maybe I want to get myself like a $5 million policy, right? And there's even also like calculators. Actually, shout out to one of the insurance companies, One America. One America has a calculator on their website, on their homepage, and I can point you in that right direction. Just send me an email. I'll send you the direct link to it, where you can actually put in there all of your specs, like how old are you? Are you a smoker? What is the current debts that you have? When do you plan to retire? And then I'll calculate of what is that death benefit coverage that you should be having on yourself. So just another resource for y'all. But then it kind of gets into, as we get older, hopefully we're continuing to make more money. Our income is continuing to rise, whether it is through the active business that we have going on or your passive monies that come in. Hopefully my income does continue to rise. And now where my mind wants to go is, that's my biggest beef with all these freaking retirement accounts. It's okay to defer your taxes because in the future, you won't be making as much money. Shut up. What do you mean? I'm not going to be making as much money. I want to be making the same amount of money, if not more than what I'm making right now. You feel me on that? Hit the like button if you feel me on that. Anyways, so as time goes on, you do need to reassess like even your foundation, your portfolios, like your life insurance, like your long-term care insurance, okay? Take inflation into consideration. Take the increase of income into consideration, the income of the increase of your net worth over time. So as time goes on, your income continues to rise and your assets continue to rise, you should be having more and more death benefit on your body. And to get back into the differences between term life and whole life specifically, when it's with a mutually owned insurance company, that death benefit is going to continue to increase each and every year. So you're literally hedging yourself against inflation, because uninterrupted compounding guaranteed interest in my policy on the cash value. And then also my death benefit's going to continue to rise because of those dividends that I receive. Now, let me just back it up. Just for my nerds out here that are listening, there's 2 types of insurance companies. There's what's called stock-held insurance companies. Is it stock-held insurance companies? Why am I second guessing myself right now? Anyways, there's stock-held insurance companies, and then there's mutually owned insurance companies. And the biggest difference is who shares in the profits of that insurance company. So at the end of the year, when that insurance company makes a profit, if you're working with a stock-held company, the shareholders of that company are receiving those dividend payouts. Where at a mutually owned insurance company, it's the policy holders. When you're a policy owner with that insurance company, you are part owner of the company, and thus you're the one who receives the profits at the end of the year. And that's what comes back to us in a form of a dividend. And how I design my policies is when that dividend does get paid out to me, then I'm able to use that dividend to buy me more paid up additions. It's just a rider that we attach onto the policy. We won't get too deep into paid up additions on this episode, but I'm able to then use that dividend to buy me more paid up additions, which is essentially paid up permanent coverage. And it's buying me death benefit, and thus it's immediately giving me that cash value inside of the policy too. So I like whole life too in that manner, where it does keep increasing every single year when I'm in working with the mutually owned insurance company. Okay, 2 more things I really wanted to hit on, and then I'm going to go to the chat and I'm going to see if there's questions over here. Next week, let's talk about next week just for a second. I am going to be up in Bama. I'm going to Alabama, everybody. So I'm going to be up in Alabama with my niece. 17. Okay. She's a junior right now. She's going to be a senior next year. And I'm trying to convince her. I'm like, Tori, you don't need to go to a university right off the bat. Okay. Maybe let's get your gen eds done at like a community college and then we'll go to like a university. But she wants to be in a sorority so bad. And she does kind of have her heart set on the University of Alabama. And it has a great nursing program over there and different things. But we're going to go up and we're going to tour some colleges together. It'll be me, Tori, my grandma, and my grandpa. I'm so excited. Grandpa makes the best collard greens, fried chicken, veggie burgers. And then grandma, she grows blueberries in her backyard. And so we're going to have blueberry pancakes and blueberry pie. I'm excited. All right. When I am in a depressed mood, I literally run away to my grandma and grandpa's house up in Alabama. I'll hop in my van. It's like an 8-hour trip and I will go and stay there and grandma will take care of me. Anyway, so we're going to be up in Alabama next week. I don't know exactly where I'm going to be on Thursday, okay? But I'm going to be on Central Time, so it's going to be 8 a.m. my time when the show goes out. And hopefully it'll work out. But worst case scenario, if I don't see y'all next week, the following week, we are going to get into what I call the white papers of buy term and invest the difference versus the infinite banking concept and comparing the apples to apples comparison on a numbers basis. Because a lot of my analyticals, you're probably thinking to yourself, well, Hannah, the reason that I do the buy term and invest the difference is because it's cheaper costs of insurance. And then I'm just making greater returns out there in the market. So what truly is like that apples to apples comparison that I can see? So I want to get deeper into like numbers on that episode for next week. But like I mentioned, follow me on my social media channels and I will keep you up to date if I will be here next week. But if not, we're going to push it to the following week. So that's what's coming up in the next week. All right. But I also want to talk about bank financed whole life. All right. A lot of wealthy people will actually use banks to finance their whole life contracts. You can do it. You can do it. You can go down to the bank and ask them to purchase a policy on you and utilize the bank finance whole life policies. And even if you want, you could even use all of these together. You see what I'm saying? Like you don't have to just stick within a lane. Even in my family, I mentioned not too long ago that my sister-in-law, she has a convertible term policy and whole life policies, which is great because it's not my story to share. She'll share her story or maybe I'll get permission from her later on if I can share it. But she had surgery this week. There was something that came up in medical and what if right now the insurance companies won't give her any more coverage because of this health condition that came up? Or maybe there's a long waiting period and maybe her health doesn't improve. I mean, knock on wood, hopefully it does, obviously, right? And I think everything will be fine. It'll be good. But she has that convertible term policy on her body. So if the insurance company will never allow her to have any more new policies to go through like that new underwriting and they just won't approve of her right now, it's okay because she has that convertible term that she can still convert the term into whole life and no underwriting has to be done. She's locked in that death benefit and that insurability on herself. So this is what I'm saying. You never know what's going to happen, but you can really marry a lot of these all together. Utilize convertible term, utilize whole life, utilize some bank finance policies as well. And bank finance policies have its place, okay? And not everybody can just 100% qualify for it. It is more used for like my high net worth individuals, but that's another reason that you can use those policies to have permanent death benefit. So your family's protected. The insurance company loves it because banks essentially can never run out of money because we have our lovely fiat currency and the fractional reserve banking here in America. So insurance companies love it because they know those premiums are always going to be coming in. And again, you got the death benefit side that's protecting your family. So bank finance whole life is another realm that you can get deeper into. And maybe I'll do like a whole episode on that at some point here in the near future. But just to summarize my notes, 50% of Americans don't have life insurance. Why? Maybe I need to do a poll on my social media. Why is it? Is it because you don't understand it? Is it because we think it's too expensive right now? Maybe you can't qualify for a policy. That's always an option too. So I just want to know. And that's my mission that I'm truly on, is even excluding infinite banking, utilizing policies for purchases and financing through our life and retirement income. Last week we got deep into tax-free income, minimizing IRMA surcharges during those years. Just totally excluding that out of it. I just want people to have life insurance. It's there to protect the vault. You're there to protect your family, because it's not an if it happens, it's truly a when. When is that time absolutely going to come? Let me sip my coffee. Today's mug, I'm a catacorn. Do you love her? I love her. I have too many mugs. What about y'all? You guys got too many mugs in your freaking cabinet? Because I do, and I need to get rid of some, but I'm like, I love them all, and I don't want to get rid of any. All right, Dexter says, love it, especially when your tone and voice changes. Thank you, my man. All right, hey, let me pop over here to my Facebook page, because through StreamYard, these comments don't come in. And I want to see if there's any comments over here. Nope, good. How about Instagram? How are we doing on Instagram? Good morning from California is what I see. All right. Well, good, my friends. If there's no questions, hopefully this was insightful. Just really wanted to get to the foundation of what is life insurance, the purpose that it serves, the different products that are out there, term versus permanent whole life. And you'll catch me back here next week, maybe next week. Stay posted on my social media channels. But until then, reach out to me if you have questions. Send me an email, hannah@themoneymultiplier.com. And also, if you do send me an email, here's my gift to y'all. Mapping out the millionaire mystery. If you're a reader, I will send this ebook version to you. Or if you want the hard copy version, just pay for the shipping. It's $3. $3 for the shipping. And I'll send it to you to have like the hard copy. Because that's me. I like my hard copy. I like to make notes in all my books. By the way, on books, I am too. So I just finished like my little love novel, which was called Archer's Voice. I liked it. What would I rate it? I'd rate it 7 out of 10. 7 out of 10 book. So I got so lost into that I kind of neglected my other books. But I finally just finished Tax-Free Wealth by Tom Wheelwright. Okay, so really organizing myself on the tax side. I'm also going to then start Wealth in Overdrive. Phil Bodine, Bodine. Phil is a good friend, even a mentor, honestly. That's a great book. I would highly recommend. My dad just finished it, so now it's my turn to read it. So Wealth in Overdrive is my next read on my nonfiction side. And then on my fiction side, I'm on the book number 3 in the series of A Court of Thorns and Roses. Yes, I'm into that stuff, okay? A Court of Thorns and Roses. I'm on number 3. There's 5 books in the series, and it's thick, all right? So I just started that also this past weekend. I was hanging down by the pool. What'd y'all do this weekend? I went to the pool. I was hanging out at the beach. It got super windy at the beach. I had to do some calls because Goofy Hannah forgot to block out her Monday calendar. So I had some calls on Monday and I was doing it from the beach, and I walk away from my towel, and when it was so windy that I came back and I couldn't even find my towel. It was all covered up by sand. And I'm like, okay, I'm dipping. I can't do this right now. We're going to go back to the pool. So I hope y'all had a wonderful Memorial Day weekend. And thank you to the armed forces. We appreciate you. We loved you. For the people who are still serving and who have served our country, you don't think about the freedoms day to day in our life that we have because of the country that we live in. So love y'all. Do well. Be good. Don't do anything I wouldn't do. And I'll catch you next week. Mwah. Bye, Money Multipliers.